Hello, my name is Dominic Frisby, and today I wanted to tell you about my outlook for gold. Gold in the age of Trump. Now, hundreds of tons of gold, so much so that there's now something of a shortage in London, have been making their way across the Atlantic to the United States, apparently to get ahead of Trump tariffs. And something like 400 tons have gone to the COMEX alone, never mind what's gone to the private vaults of HSBC, JP Morgan, et al. And a lot of people are getting their knickers in a twist about this, with a shortage of physical gold for delivery in London, waiting times now as long as 8 weeks apparently, and the Bank of England refusing to comment. There are all sorts of rumours flying about, and it's not a great situation, but there are something like 8,000 tonnes in London, so 400 tonnes is not that much, and London remains at the epicentre of the physical gold markets. I don't think we're going to get a proper run on gold. It's possible, but if we do, talk about the unintended consequences of tariffs. I think it's highly unlikely. It's just a little bit of noise, a little bit of zip in the normally quite sleepy physical markets. But anyway, let's come to my outlook on gold for 2025. Before I do that, I wanted to plug two things. Now, one is my friend Charlie Morris's newsletter, Atlas Pulse. It's a monthly gold report, and it is, in my view, the best, bar none, gold newsletter out there. And best of all, it's free. I'll put a link in the comments. And two, if you're thinking of buying gold, and I think everyone should own some, my preferred bullion dealer is the Pure Gold Company, and you should get your gold and silver to them. And it doesn't matter if you're in North America, in Europe, in the UK, that is the place to get your gold. And I will put a link to them as well in the comments. Now, an aeroplane just flew over. I think you probably heard it. Hopefully there won't be any others. So the gold price, some barking dogs as well. The gold price has been rising relentlessly since November 2022. And here we are, 2025, within a few dollars of all-time highs, around $2,800 an ounce. It's at all-time highs against the Japanese yen, against the euro, against the Swiss franc, against the Great British peso, the Aussie and Canadian dollars, and pretty much any other fiat currency you care to mention. And yet, I don't recall seeing any mention of this, or hardly any mention of this anywhere. It's a stealth bull market, the best kind of bull market, because it means there is plenty more hype left in the tin. Private investors are almost completely ignoring gold. In Germany's normally one of the biggest buyers of physical. I gather we're actually seeing net selling in some cases in the retail markets. And one reason is that a lot of Germans bought gold during COVID, and there's a lot of profit to be had. And secondly, because the economy is in such a poor state, people need the money for something else. Higher interest rates, which began during COVID, they've dampened both investment and speculative demand for gold. And a lot of the money that fuels the junior end of the mining markets, the small caps, also comes from retail buying. And if they're not buying bullion, they're certainly not buying miners, and hence the atrophy there, although some miners are starting to creep up. So, who is buying then, if the price keeps on going up? And the answer, as regular readers of the Flying Frisbee will be able to tell you straight away, is central banks, especially in Asia. And this trend is accelerating. It began accelerating after the US began freezing Russian assets after its invasion of Ukraine. China imported 124 tons just in November, Jan Neuenhaus of the Gold Observer tells us. It's bought over 1,000 tons since the Russian freeze, 1,000 tons. And it's buying 400-ounce bars from London, which are almost certainly making their way to the People's Bank of China. 400-ounce bars do not trade on the Shanghai Gold Exchange. So it's going straight to the state. It's not going into retail. And it's also buying 3 times as much as it says it is. 3 times as much. And the explanation is obvious. Central banks need reserve assets which other governments cannot freeze, so-called bearer assets. And gold, which is value in and of itself, is the answer. There is no equal. Not in the physical world, at least. And so here we see gold as a percentage of central bank reserves, it's now at 20%. Now, I doubt we ever go back to the heady pre-World War II days when gold made up 80 to 90% of reserves. Money wasn't fiat then, but you can see the trend is very much up, and it's been up for 10 years now. The percentage has doubled in that time from 10 to 20%, and I see no reason why it can't double again in the next 10 years. 40% of reserves held in gold seems like a reasonable number, a conservative number. The United States, if the gold is there, has something like 70, 80%. Nations are, says Neumann-House, obviously preparing for a multipolar world in which the dollar's role as a reserve asset will gently be reduced. Now, you can look at all of this and you can describe the process as natural and sensible asset allocation, diversification away from other government currencies, especially the US dollar. Or you can proclaim that other nations are preparing to abandon the dollar and they're preparing for a new gold standard. I would say it's probably about 80% the former and 20% the latter. 80% asset allocation, 20% new gold standard. That might well change, but we are not there yet. Nations, while they might not be so much abandoning the dollar as they're simply increasing their gold holdings, they are, however, reducing their holdings of US treasuries. That is de-dollarization and diversification. At the moment, the whole process is covert and benign and understated and underneath the radar, but it may become a lot more significant a few years from now. And I urge you too to be diversified and own plenty of gold. It may well be that you're going to need it, and you're better off booking your seat on the lifeboat now while they are still available. This is especially the case if you are in the UK. There has never been a Labour government that did not devalue, and this particular lot are flip-flopping and clueless. So I'll put a link in the description to my guide to buying gold in case it is of use. Now, I don't see any reason for this central bank buying to abate, by the way, and my prognosis is that it continues. What about the new president? I want to briefly consider gold and President Donald Trump. Here is what gold did last time he was in power. And it roughly goes as follows. Gold sold off after his election win. It had a decent first year, then it sold off in year 2, but in years 3 and 4 it had a great time and it broke $2,000 for the first time, record highs. So far, gold has mirrored its price action in Trump's first term. We had the post-election sell-off and the early January rally. It will be interesting to see if the price action continues to mirror, but if it does, we see breakout to new highs in 2 or 3 years' time. I really wouldn't be surprised if it does, though I'm bullish. Finally, and significantly, we have gold and the US government 30-year bond, the long bond, and normally the two rise and fall in tandem. That relationship broke down briefly between 2011 and 2015 when gold sold off after a long bull market. But otherwise, they mostly mirror in a dance that goes back many decades. But that relationship has completely broken down since COVID and the Russian freeze. The long bond has sold off, breaking an uptrend that's been in place since 1980. Gold, meanwhile, has risen. The two have decoupled, and this breakdown will continue as long as the market fears interest rates will continue to rise. The great bull market of the 1970s only ended with the enormous rate rises that came with the Volcker shock. Gold then fell for 20 years as the market rightly anticipated rates going lower. We're quite some way from another Volcker shock, even with everything that this government is doing. I don't think this is something that Trump wants. In any case, thanks for listening. Please subscribe. Until next time, goodbye.